Hello, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We are thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box, go ahead and leave your contact information as well. And if we can't get to your question during this event, we'll make sure someone reaches out to you to address that question afterwards. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our guest today. Stephen Abernathy is the founder and chairman of the Abernathy Group 2 Family Office. Prior to this role, he was recruited by Shearson American Express, became senior vice president of portfolio management there, later became a partner at Cohen & Company, a research and trading boutique specializing in healthcare and technology. While at Cohen, he developed the Abernathy Group, which is a group of investment professionals specializing in asset management for experts in healthcare and technology. This collaboration between investment professional and client expert was called the collaborative investing style of portfolio management. The collaborative effort forged between Mr. Abernathy's financial knowledge and the technology and healthcare expertise of his clients has produced top-tier results. Mr. Abernathy later co-founded the Abernathy Technology Research Institute. He is a member of CFA Institute and the New York Society of Security Analysts. The Abernathy Group 2 and its predecessors have been ranked number 1 16 times by Nelson's World's Best Money Managers since 1991. He has been the chairman of Abernathy Group Family Office since 2015. And Stephen, we're so excited to have you here. I'm going to ask a couple questions before we get into it. I know that we have marketed this webinar specifically for doctors, medical professionals. Can you tell me a little bit about how you got into this space? I know that your practice is specifically emphasizes work with this population.
Yes, Moshe, and thanks for having me back. I really enjoy doing these discussions or participating in these discussions, especially if we have some information or data to share. As you said, I've been working with the medical community since 1986, and from that work we've done, we trademarked collaborative investing in 1998, and it's been a wonderful relationship. We've worked with literally hundreds of medical professionals on everything from integrating their practice into the hospital to creating their retirement plans or 401k plans to helping sort business challenges. And during that process, I will tell you that there's been a lot of just listening and letting the medical profession vent, because it's changed significantly over the course of the last 30 years. And I feel not for the better. I think a lot of medical professionals also feel like that. They're more rushed. They're less well reimbursed, and that's part of what we're going to talk about today. Ways to fix that.
All right. Well, let's go ahead and get into it here.
Okay. Well, great. So there's so many things to talk about, but today's discussion will primarily diagram the 5 major reasons medical doctors need help in today's financial environment. And before I get started, I want to make sure all participants understand this discussion is for educational purposes. And the views offered today are based on my personal views after many one-on-one conversations with medical doctors over the last 35 years, and after sponsoring a lengthy study involving data from hundreds of physicians. On the other end, our firm does not sell financial products. We are legal fiduciaries, and this presentation is solely for the benefit of the physician community. So I think it's important to point out that there are many fine institutions capable of serving physicians. If after this discussion you believe you could benefit from the expertise of a true financial expert in medicine, I'll outline the best way to help you find a good fit for your family. And if you're having trouble finding a reputable professional, we'll do our best to help you find one.
What is the most challenging type of problems that physicians face today?
That's a hard and lengthy answer, Marche, but it's a really good question. So the practice of medicine is under attack on almost every front. Why? Reimbursements are falling and continuously under attack. The EMR is creating layers of additional work and requires physicians change the way they run their practice often. HIPAA compliance and cybersecurity threats are always, up front or either running in the back of their minds. Increasing patient visits in clinic, decreased time per patient, which increases the risks of mistakes. And medical doctors in private practice, they're faced with rising personnel costs and training, which also requires time that it's often just not available. And it feels as if it's only going to get more difficult for the physician community. There's an epic shift taking place in what we believe will separate the successful physician from the average physician. Our research shows that 1 out of every 2 physicians is having trouble retiring on time. While the practice of medicine is still providing an adequate level of compensation, it's become clear to us that the decisions being made outside of medicine may be damaging the wealth of the physician community.
That's really interesting that you talked about the 1 out of every 2 physicians is having trouble retiring on time. I'm really interested in seeing how that goes forward.
Yes, and I might add, it's a little disturbing because this category of our citizen is among the most important categories of citizens on the planet. If the medical industry isn't taking care of themselves, I will tell you that we're in trouble. So okay, the main takeaways from our study are that the most successful doctor over the next decade will be the one that practices medicine well, yet manages their business and personal wealth better than historical peers. The best medical doctors in the country will build cost-effective relationships with the best business and legal minds in the country. And just as an example, just like star athletes or star entertainers, the most successful physicians will stick to what makes them great while surrounding themselves with the most qualified business and legal and often tax minds they can find. Also, a trusted quarterback or a personal chief financial officer, it's become so incredibly inexpensive and may actually save physicians thousands of dollars per year while allowing them to recover over 100 hours of newly found time not spent on financial or legal or tax matters, which they can devote to, I don't know, either medicine, family, or hobbies, or any of them. They're all worth their weight in gold.
That's
So
really,
I'm sorry, go ahead,
yeah,
Marcia. Yes.
that sounds like a great, I'm really excited to get into these issues. So let's go ahead and move on. I know we have some specific points that you specifically have said that doctors really, you hear this over and over and over again.
Yes. So when we started our research on this topic, our original goal was to find out, why physicians who were among America's most well-paid community were not becoming among America's most wealthy. They've been among the most highly paid individuals in the United States for decades, and they're clearly among the most intelligent and well-educated. There's no question. Yet for years, physicians have been among the most, they've been among the worst cared for clients in the financial industry. And unlike other investors, physicians are truly caught between a rock and a hard space. As mentioned, the costs of operating a practice are increasing while reimbursements are decreasing, and they're forced to see more patients than time often allows. And because of the increased documentation requirements, courtesy of the EMR, doctors are bereft of the time necessary to manage their personal finances appropriately. And they often don't even have the time to run their businesses efficiently or effectively. So physicians have traditionally turned to financial professionals for help. And typically the relationships start with promise, only to find the financial professional's advice is not aligned with the physician's interests. Eventually, medical doctors are going to realize that the Wall Street machine has its own objectives, and those objectives are often not aligned with the physician's interests. Many physicians begin to manage their own investments and make planning decisions with little professional guidance. And here's what our study shows. Few physicians today feel a sense of clarity about the financial future. They just don't know how much they will need to retire and maintain their current lifestyle. Few have an understanding about the impact today's decisions might have on their future, or how to calculate that impact. Few physicians have an easy method of tracking their investments against their retirement goals, or they can't see the value of everything they own quickly and in one place when they need to. Few physicians have the kind of protection for their personal assets which are needed to safeguard their family from frivolous lawsuits arising outside of the office. And few physicians have a chief financial officer they can trust for their financial questions, or they often don't have an advisor whose advice they trust to be independent of conflicts. So there are many reasons physicians need help. Today, we're going to discuss 5 of them. Physicians are just too busy for activities which are not medically related. There simply is not enough time for the medical doctor to listen to ideas, return phone calls, make intelligent decisions about business and financial topics. They have little time to adequately research. They realize their time is best spent keeping current with the technological innovation impacting healthcare. And they know it's absolutely necessary and it pays big dividends. But just as an example, the impact of artificial intelligence on the medical community is becoming profound. Yet few physicians have the time to incorporate the benefits of artificial intelligence or AI, and they don't reap the benefits it offers. And this lack of time is unlikely to get better in the near future.
Mm.
The requirements of today's physician have evolved over the last decade in a way that demands the physician to spend more time in the clinic, and that often results in seeing 2 or 3 times the patient load they saw over the last decade. On top of that, the demands created by the integration of the EMR also forced the physician to spend more time documenting activities, which often took several more hours per day to integrate into their practice. And of course, CME requirements have continued to demand every physician's personal time.
That
So
can be a huge burden, I'm sure, on every physician.
it is a lot of work that isn't, I guess people will say it's required, but it isn't delivering patient care, and that's what the physician's all about.
Mm, I can see
So
that.
so the bottom line there is physicians just don't have the expertise demanded to provide top-notch investment analysis. You know, physicians are not financial analysts, and it creates a problem Warren Buffett often describes as a circle of competence challenge. You know, he advises everyone to stay within their circle of competence because when you leave your circle, you're likely to enter someone else's circle of competence, and that the odds now stack against you pretty hard. Here's the challenge. Physicians have been the smartest people in their class since the beginning of their comparative education. So it's difficult for them to admit someone's more able in any walk or area of life. Financial analysis demands expertise, and expertise demands decades of experience in finance, and it demands an audited track record. Remember that phraseology, and we'll discuss why that's important and how to find this later in the discussion.
All right. You know, it's so funny because I think just about getting to the point where you have a circle of competence, and medical doctors know exactly what that takes. It's decades of learning and experience. And so to ask that of themselves in another field is, you know, outside of what could be expected of anyone.
Yeah, it's true. It's a great point, Marche. So most physicians don't enjoy the rigors of financial research, yet it's, you know, when they take on their financial decision making without help, it's all on them. The majority of physicians are academically oriented. Their primary interests lie within the study of medicine, and they just don't enjoy the constant daily demands required to make the best financial decisions. So, and to be third grade math with you, you know, when physicians do the math, they'll find they will earn much more focusing their time on medicine, which they enjoy, as opposed to the financial research they don't enjoy. The simple math is that a physician making $500,000 or more per year is earning $250 or more per hour. It's relatively easy to outsource financial, legal, and accounting expertise for much less than that, which is a very, and most of the time under $100 an hour is what it would cost the physician, which is a very small fraction of their income. And as you can see, the math works in the physician's favor to stay within their circle of competence. So the summary, physicians focusing or staying within their circle of competence is likely to generate more income along with better medical and financial outcomes. And one more note, which isn't trivial, by staying within your circle of competence in the study or the practice of medicine, the physician creates the gift of newly found time, which can be spent focusing on family or hobbies rather than financial demands. Physicians also, they they aren't used to bartering or negotiating with patients regarding fees for their services. The medical community has never had to negotiate with patients about rates or payments. Physicians have been so well paid over their entire history of healthcare that dealing with financial matters is not part of their DNA. Most physicians' DNA. It's always been patient care first. They seldomly had to focus on efficiently managing their wealth, and their education didn't include any aspect of finance. The problem is that this creates a reluctance with some physicians to get help with their financial matters, and that's a challenge.
That's interesting how you say that. I know that we had talked previously about, a lot of education goes into the nuts and bolts of doing the patient care, but very little, if any, on running a business, which is primarily a financial matter.
Yeah. Delivering patient care and running a business are two wildly different and I would say distinct areas of competence, and they're not naturally related to each other.
Mhm. And then when you think about also, running your personal financial matters is also similar to running a business. So that's even a third thing.
So the last and most at times most subtle challenge is many physicians don't know how to find an expert financial advisor who's trustworthy and competent. And here's the reason. Physicians often don't know the correct questions to ask. Just like a patient often doesn't know the right questions to ask the doctor to get quality care, doctors don't endemically know the correct questions to ask to find out who's competent and who isn't. So outsourcing is an incredibly important dimension of managing wealth. And later, I'll describe it in detail how physicians can completely change the game and put the odds in their favor by directly employing proven experts. And we'll do that just a little bit later in this discussion.
Great.
So here's what we found. Physicians, and this is the primary problem, physicians are failing to grow their wealth in line with their income generation. And here's some solutions. The first easy solution may very well be for a physician to find a financial expert they can trust. From the financial aspect, as we just went over, this is a simple calculation. Every hour the physician spends on financial matters is an hour spent not generating revenue in their practice. Remember, our simple financial calculation that demonstrates a physician making $250 per hour can outsource expert advice that they can trust with the right person for a small fraction of that. And at the same time, it's likely to save them hundreds of hours per year in just found time. Our studies show that many physicians don't have a trusted expert who can act as a virtual quarterback. And this person is able to take care of the operational aspects of wealth management while involving the medical doctor on all important decisions. And the most often cited reason for this lack of a quarterback is that they simply don't know how to find an advisor that offers expertise along with an understanding of the demands involved with the practice of medicine. For instance, the right advisor for a doctor needs to be available when the doctor's available. And doctors are on call. Doctors have all kinds of demands that aren't 9 to 5. Next, most physicians have not taken the time to create a budget. They need to understand the budget must embrace both a certain current lifestyle while saving enough for their life after medicine. It's not difficult, yet it requires a bit of time and expertise, which is best offered by an analyst which has done this before. And I might also add, it requires the medical doctor's commitment to review this process several times per year, especially in the beginning phases, as budgeting is always an iterative process. Next, we found two risks regarding the investment portfolio in the medical facility. We found two risks. Studies show that physicians believe they must take higher risks than needed to reach their financial goals, while other physicians have set financial goals which are unrealistically high. For instance, a study performed by the Securities Industry and Financial Markets Association, very famous society, it's called SIFMA. They've demonstrated that the average investor believed they could generate returns of well over 15% per year, while the average return generated by the stock market was a bit under 7% per year.
Wow, that's quite a difference between expectation and
So
reality.
how people who are not professionals, or even how professionals think that they can double the normal rate of return of the stock market is a real head scratcher for me. The combination of the medical industry's unrealistic expectations and the extra risks taken by physicians to achieve those expectations have resulted in returns which are significantly under the average market returns. Our studies show the average investor realized a return of slightly under 2% per year, while average market returns were almost 7% per year, as we just said. You know, doctors are probably loath to admit it, but as Warren Buffett has said many times, buying an index and earning an average return is often the best outcome. In short, the medical industry's unrealistic expectations and too much risk clearly damage physicians' ability to create wealth.
Very interesting.
Next, and I think this is either among the most common mistakes or the most common mistake we've experienced over the last 35 years, is that physicians fail to hire advisors who are, number one, true experts in financial analysis and portfolio management, and or B, who are legal fiduciaries acting as true advocates for the physician and the family. Most of those calling themselves financial advisors have little or no documented history of financial analysis. And the medical industry just doesn't ask for that proof or that documentation. Additionally, most are employed by a financial firm as opposed to working directly for the physician. It's a structural challenge. This
All right.
often leads to conflicts of interest. And believe me when I tell you, conflicts of interest should be avoided at all costs and all times. Physicians often mistake salesmen for experts. This is easily accomplished by creating a relationship where, or this is easily alleviated by creating a relationship where the physician hires a financial analyst or a portfolio manager directly by their medical practice. This takes away conflicts of interest and ensures the financial advisor is working directly for your family's best interests. And I might add, this structure is less expensive than most brokerage relationships. So it's a cost savings, it's often a cost savings, and it alleviates conflicts of interest, and it's just a better structure.
I did have a question come in here about the recording of this presentation. Yes, we will be sending out the recording in an email later. So thank you for that question. Let's go ahead and move on.
Okay. What kind of advisor would be a good fit? it's incredibly important for the physician to find a portfolio manager or an analyst that is truly an expert as opposed to a great communicator or a great salesperson. Here are the qualifications which, when found, are most likely to provide you with a suitable outcome over time. And it's pretty clear that this process will increase the odds of having the physician achieve their goals. First of all, the trusted advisor must have an audited track record by an independent and well-recognized accounting firm. One fact most physicians don't know: all professional investors, every professional investor has an audited track record, just like all medical doctors have a medical degree. If the advisor doesn't have an audited track record by an independent accounting firm, it's highly likely they are not a professional investor. If they're unable to offer you an audited track record, the best advice is just to move on and continue looking, because you don't need to settle for less. True professional investors exist and are available, and you just have to find them. And by the way, it's well worth your time. The second is your trusted advisor must be a legal fiduciary, and they must be willing to sign a guarantee that the advisor will always be acting as a legal fiduciary. Here's why. The brokerage industry is pretty clever. They devised a strategy that legally allows an advisor to wear two hats. One hat is for the brokerage firm salesman. This hat allows the so-called advisor to have conflicts of interest and to sell products with commissions and high fees. The other hat is the one of a fiduciary. And this is how a lot of salesmen can claim they're fiduciaries, because at times they are. But most of the time, or some of the time, or I don't know what percentage of the time, they aren't. But when they are fiduciary, it means the physician needs to be able to figure out which hat is being worn each time the advisor makes a suggestion. And this is a lot of work and can be easily avoided by making sure you're dealing with a legal fiduciary at all times. Make the advisor sign the always legal fiduciary agreement. It'll save you hours of time. It's not an optional requirement. And after all, just to put it in perspective, how would you feel if your patients were forced to use a physician who worked for a pharmaceutical company with a blatant conflict at almost every turn in the road, and who only prescribed medications owned by the pharmaceutical company who employed them? I mean, that's sort of a fairly representative analogy. Next, make sure your advisor has a comprehensive understanding of your financial life. When you create that trusted relationship with a financial expert, it's as important for that expert to understand as much about you and your family as you would need to know about your patient before undergoing a medical procedure. You know, when your financial analyst understands your goals, when they understand your time frame, and they understand your financial expectations, it allows them to advise you about important decisions which will most likely impact your family's financial future. This is the reason your trusted financial advisor must be both a professional investor and a legal fiduciary. And in our opinion, there can be no slippage between your confidence that the advice you're being given is from an expert, and that advice is based solely in your family's best interests. So, this slide is descriptive of where the significant time savings come into play, and it can easily save you over 100 hours per year that you can devote to other interests or to your medical practice. So, we need to make sure that your advisor is all seeing. Make sure your advisor can work with your attorneys, with your accountants, and can integrate advice from all the experts serving your family before the advisor brings you suggestions. This creates a more comprehensive relationship, and it's likely to deliver more intelligent decisions and often provide much superior outcomes. As we mentioned, just I guess a little earlier in the presentation, one of the most serious financial mistakes made by the medical profession is created by taking on too much risk. When you follow a written budget, which is created to balance your lifestyle with your retirement goals, you'll be better able to determine the levels of risk you and your family will need to embrace. Trying to keep up with or outperform some irrelevant index discussed by the talking heads on TV is nonsense, and it really can destroy wealth. It's much more intelligent to ensure your advisor structures your portfolio to deliver a certain return relative to the risk being taken, rather than structuring a risky portfolio to try and outperform the market each year. Many physicians are taking on more risk than needed, and it's jeopardizing their ability to create true wealth. So that, I guess that leaves our study, and here are, I'd like to talk you through 10 relevant questions that, when answered, may help you determine if you need help, and if so, where. It's the last topic we'll cover today, and I don't know, your answers really will help you determine if you need help and what kind of help might be best for your family. So the first question is, what are the hardest topic I have to deal with? And the hardest financial topic often includes several answers, and each answer may help you determine where you need help most. Question 2, what's the most annoying financial topic I have to deal with? Well, remember, if you have several annoying topics, outsourcing these to an expert quarterback you can trust, it may very well make sense, and it certainly will save you both time and money. Question 3. Regarding your financial future, what do you most often forget to do? Remember that forgetting to take advantage of valuable tax expenses, or forgetting to ensure capital gains are taken in your taxable, investment portfolio as opposed to your retirement portfolio, could increase both your tax rate and the absolute amount owed to the government. And that is a goal that most physicians embrace. Question 4, what financial decisions have I had to wrestle with? And the most common decisions you've had to wrestle with, they'll give you an inkling as to the fact that if you have a list that consists of more than one or two difficult decisions, it's likely that a relationship with someone who's a competent, trusted advisor will help you save both time and improve your decision making. Question 5, what decisions do I expect to wrestle with in the near future? As said, if you know a difficult decision is in your immediate future, it may be incredibly helpful to have access to someone with wide-ranging experience regarding decisions leading to successful outcomes in the medical industry. This is oftentimes not new. Many of us who help physicians have seen this movie before, and as often as not, it helps to talk through the positives and negatives of decisions with someone who's knowledgeable, as the diverse perspectives that others bring can alert you to ideas you may not have considered previously. Question 6, how many different accounts do I have? This is quite common. And when you notice how many different accounts you have, simplicity may become important to you. And if you would like to save time during each review period, it makes a lot of sense to keep your financial structure as simple as possible, yet not so simple you miss valuable legal asset protection strategies, which are among the most important of all considerations. And that is something that we find that sort of 80% plus of the medical professionals we serve forget about. You need to legally protect your assets. Question 7 is a common one, and it's a painful one to answer. If the answer to this question is yes, it's likely that having a trusted expert advocate will help you answer no next year, because they often uncover ideas and sort of areas that you've overlooked. Question 8, do I wish I had deeper research on my investments? And this is a question most often answered in hindsight. However, having inadequate research and data is often a certain recipe for the wrong decision. Making the right decision for your family's financial future is as important as running your medical practice effectively and profitably. This is a question you would be best served as answering no to. Question 9, how do I stress test my portfolio to know how it would perform in a recession or difficult economic periods in our future? And this is another question you'd like to know the answer to well in advance of the eventual outcome. It's the right question to ask, and it's a key determinant in your family's eventual financial success. And as most of you know, we're entering a very difficult period. We're likely to be entering a very difficult period. So it's a question to answer sooner rather than later. And lastly, how often do you want to communicate with your advisor? Don't forget, every hour you are not spending in your medical practice, you're losing money. So the answer to this question must be customized to fit with the demands on the physician's obligations. As often as physicians are on call, and the trusted advisor must be on call for the physician. This is one of the unique demands on the advisor community who of those advisors who dedicate themselves to working with the medical community. So those are 10 questions that may help medical doctors or physicians figure out whether they need help or not. Can we turn it back to you, Marche?
Yes, we're going to go ahead and open the floor up to some questions that we've gathered here. We don't have a lot of time, but we'll go ahead and address these. And then again, if you have a question, go ahead and put that in the chat. And if we're not able to get to it, go ahead and put your contact information in the chat as well. All right, here's the first question. So if you have an advisor from like a big name firm, like a brokerage or some other institution, and you use them maybe for years, what would be the reason to go after another advisor? So to switch or maybe get a second opinion. Can you talk to that?
Well, almost every medical doctor or every physician that I've ever met will caution patients to get a second opinion before anything or any significant procedure is embraced. So a second opinion by a legal fiduciary who is an expert certainly is welcomed. It might also be, you know, we call them blind spots, and these are things that you don't see because you're comfortable in a relationship. And I would ask them the question, show me a track record that's audited by an independent accounting firm, and make them sign a legal fiduciary agreement. Those really are the building blocks of a good relationship. And I will tell you that most firms won't allow their representatives, most of the larger firms, to sign these agreements because they don't operate as fiduciary all the time. And so I'm not advocating that you change, but I am advocating that you get a second opinion from someone who is knowledgeable and who knows who knows where the cracks may be in the
All right.
relationship.
Thank you. So you talked about an audited track record. So do you get that specifically from the advisor that you're looking at potentially engaging? And what does an audited track record entail?
Yes, you get it from every professional investor has a track record that's audited. Most of them are public, meaning that, it's easy. You needn't. Warren Buffett's track record is Warren Buffett's track record. It's there for everyone to see. Most professional investors who've been the head or managing funds, those funds are a matter of public record. So if the advisor doesn't have an audited track record, they clearly aren't a professional investor. They may say they are, but it's the same thing as someone who says that they're a doctor, but they don't have a medical degree. They may be intelligent, they may be talented, but they aren't a medical doctor. And that's the only analogy I can give you. And what's involved in it is the accounting firm. Each year, every professional investor has an independent accounting firm go through the numbers and produce an independent assessment of the performance of the funds for the past calendar or fiscal year. So that's what's involved, and it's expensive.
Thank you for that. So we talked a lot about having an advisor that knows the ins and outs of your financial life. When you start a relationship with a new advisor, about how long does it take to get up to date on those kind of things, and what kind of time frame are people looking at when they work with a new advisement firm?
I don't know that I can answer that as well as I should. I know that what we hear most often from the medical community is that trust is the most important variable, and from trust, everything else is under that. They need to be good communicators. They need to be available when the doctor needs you. But trust takes time to develop, and it's the truth. That's why it's the same thing with a doctor. When I walk into a physician's office, I see their degrees. It's not a guarantee of trust. It's just the beginning layer. And I think asking or having a track record, asking or having the guarantee that the advisor is always a fiduciary. They're a financial lawyer. These things are important, and each will build on the level of trust. And over time, again, there's no sacrifice for putting time in with the advisor. That's another reason that it's important that you and your family enjoy, or at least like, the advisor, because if you don't like the advisor, or there's just something rubbing you wrong with them, you're not going to spend the time with them that's needed when they need you. So those are a couple of hints. I don't, if those don't answer your question, come back to me with that.
All right, let's go ahead and move on to another question here. So this is, I'm going to generalize this question just a little bit. Can you talk a little bit about a fee structure that might be involved in engaging an advisor? Talk
Yes,
a little
yes,
bit about that.
for sure. Yeah. So the brokerage industry charges a fair amount of money. When you see the quarterly statements that Morgan Stanley or J.P. Morgan offer, or any of the public companies, you'll find that they're making $3 to $5 billion per quarter. So I think what a lot of this depends on your asset amount. The larger your asset amount is, the lower the fee should be. It used to be that medical professionals were paying a little bit over 1% per year. This should be hard history for anybody that has well over 7 figures of income. It is quite often the ability that over time you'll be able to pay less than 1/2 of 1%, and that should be sort of your goal. You should start out at saying a fraction, maybe 3/4 of 1% as a beginning, and that should be, again, sort of moving down towards that 0.5% level. And when you get to that level, that would be, you'll find that is well worth your while to not spend working on financial challenges. That's the key to outsourcing.
So what about an age range? So should physicians who are maybe younger, just coming out of medical school, work with different types of advisors than maybe advisors who are adept at working with older, more established physicians?
It's a good question. I don't think, I think that an advisor who works with physicians is it's the right church. I don't know how to recategorize it from there, but I think it's safe to say that the medical doctor will know the right investor or the right advisor when they start dealing with them. I don't know how to answer that one very well.
Yeah,
Other than
okay,
that,
that's a good question. Maybe we can talk about it a little more, Stephen, and I'm happy to email this person, let them know what our thoughts are after the webinar. I have time for one more question. This is a good one, and then we'll get your closing thoughts here. So I know we talked a lot about outsourcing. The question is having a financial advisor handing everything over, or is it more involved? How much oversight should a doctor have over their financial matters? How involved should they get when working with an advisor?
The simple answer to that is you should never hand everything over to a financial advisor to anybody. These are your assets. However, over time, see, in the beginning, I think that it is important to have lots of communication back and forth. That's, you're going to see how the financial advisor responds to relevant questions and to challenges. Over time, trust is created and competence is proven. This is why going into the relationship, you need to find that audited track record. You need to find that fiduciary agreement. Those are two staples. However, I guess you were asking, so the main decisions should be at best the doctor's decisions based on advice, both positively and negatively, from the advisor. However, as time goes, more of those decisions, the decisions have been made, the posture or the risk levels have been set, and I think at that point, it is legally up to the advisor to make sure that those risk levels are protected. So
That's interesting. So yeah, as the relationships develops, that person knows, or that advisor knows a lot about their client, and can, from past experience, knows what would be the good fit for, what would be the best fit for them.
it's time. It takes time. Yes, it
Yeah.
does.
Yeah. Okay, we had one more come in, and I want to address this because I feel like this is more of an easy one to answer. Does an advisor need to be a CPA, a lawyer, and an experienced financial advisor?
No, no, an advisor doesn't need to be, an advisor needs to understand enough about each of those business verticals so that they can have conversations with your attorney, with your accountant, with the people that are helping you run your practice. All of those things are necessary, but they don't need to be. It's very hard to find someone who is a CPA and an attorney, and who actually is a professional investor. So they don't need to be each of those, but they need to be able to deal and integrate the information coming from each of those business verticals before, as I said earlier, I think before decisions are made, because the advice from, you don't want to miss a tax deduction, and you don't want to have a portion of your family's wealth legally, how would I say, frameworked so that it's available for others to have access to those assets. So the short answer is no, and the long answer is they need to be able to integrate the advice from each of those disciplines, in our
Yeah.
opinion.
Yeah, thank you for that question. And we did have one more that came in about can an advisor work across states?
Yes, advisors can and will work across states.
All right. Well, that's all the time we have for questions today. I know we had a couple more come in. I will try to address that at the end here. But before we go, Stephen, what kind of last thoughts do you have for our physicians who have been on this webinar today?
Well, it's clear that the practice of medicine is changing, and the most successful medical doctor over the next decade will be the one that practices medicine well, yet manages their business and personal wealth better than their historical peers. Are there medical doctors who can spend enough time to become experts in finance, accounting, and legal matters? Of course. The answer is yes. The physician community is clearly among the most intelligent and well-educated sector of our economy. They could do all of those things if they wanted to. Unfortunately, we at our firm believe that's the wrong question. We think the right question is dealing with complicated legal, investment, and business decisions the best use of my time? Or maybe even a more simple question is, what is the best use of my time? I think in the future, physicians that answer this question correctly are much more likely to prosper and become very successful financially. Those who spread themselves too thinly are likely to join the ranks of the averages. And that's all for us today.
Well, on behalf of Advice Chaser, we want to thank Stephen for being here. We want to thank the organizations that have worked with us to bring you this webinar today. Thank you so much for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. I know that was one of the questions we got in the chat here. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.